Hello everyone and welcome back to our Vision Stage Day 1. Gold and other precious metals have seen a strong rally, and that's changed the way brokers and liquidity providers think about pricing, hedging, and delivery. This session brings together people from across the bullion market to discuss what the latest moves means for APAC and how the region is adapting. Please give a warm welcome to our moderator, Judy Go from Integral, and our panelists. Let's welcome them with a big round of applause.
Thank you. Hi, good afternoon, everyone. Welcome. My name is Judy. I'm from Integral, a company that offers trading solutions to banks, brokers around the world. I'm really delighted to be here today to moderate this panel with an esteemed panel of experts. So I think before we dive in, perhaps let's do a round of introductions. Would you like to start?
Sure. Hi, my name is Alex Ferguson. I'm here on behalf of Woodside Holdings Investment Management, which is a CMS license holder, and we allocate and invest money on behalf of high net worth families. As part of a broader group, I also represent Global Precious Metals, which is a global bullion brokerage and custody business based in Singapore, in which we have an equity interest, and also a company called Atlas Consolidated, which owns Hugo Save in Singapore, which is a retail value proposition that, among other things, allows retail investors to buy and sell physical precious metals in a tokenized format.
John Murillo, Chief Dealing Officer over at B2 Prime, B2 Broker group of companies. We are a liquidity provider and a technology vendor.
My name is Alex. I'm from CMC Markets. So mainly I'm dealing with the day-to-day to the premium clients management. At the same time, I'm also taking care of the overseas expansion for CMC Group.
Hi, I'm Kueh Guan. I'm from the World Gold Council. So the World Gold Council is a not-for-profit market development organization for the gold industry, and our goal is basically to improve demand for gold across the world.
Thank you. So let's dive right into it, shall we? So I think you will agree with me that gold has had quite a year. And actually what's more fascinating is the conversations that's happening at the side of it, which is, you know, how it is evolving, how bullion market as an entire market is evolving all across Asia. So that's what we're looking to discuss today. I think before we go into that big picture, I just wanted to start off with something very specific. So if you remember January 28th this year, in a single session, gold futures moved more than $200, making that like the biggest single day movement for gold, and also it reaching the price peak. And then silver reaching $120 per ounce the next day. So, I mean, if you cast your mind back into that most intense day in the history of the bullion market, be it like system failure or a customer calling you that you didn't expect, or, you know, maybe a realization that, hey, the market has shifted. What does that moment look like for you? Maybe we start with Alex.
Yeah, that's a very interesting question. We've seen, you know, a 6-month period of very interesting activity. I think for us, as an allocator of capital and putting my investment management hat on, I would say that during that period we took an opportunity to exit some of our exposures to physical precious metals, in particular to gold. Although fundamentally we hadn't changed our position to whether one should own gold as part of a diversified portfolio for either ourselves or our clients, we saw the momentum movement at that time as pretty extraordinary and took an opportunity to realize some of the gains that we had seen. Fundamentally, though, we still recognize that physical precious metals represent a very good way to gain exposure and hedge ones and diversify, you know, away from certain systematic risks. You know, there were some pretty interesting events occurring both in January and in February particularly, and March exceptionally. And I think I'd be very interested to hear some of the guys who deal in the derivative space, particularly around what what they were seeing. We operate principally in terms of allocation through Woodside in the physical space. In global precious metals, it's very much in the physical space as well. But that, that engagement in the derivative space and the volume in the paper market was pretty large at that particular time. So, yeah, I mean, you head into March, the activity around central bank selling was of particular interest to me, and remains so. That remains a very active market today.
Cool. What about you, John?
Well, as a liquidity provider, I think we saw that day a bit of a chaotic point for many of our partners, caught many by surprise. I think CME, hiking margin rates, all it did is trigger a ripple effect within the industry. And that's what the consequences of that event led to what I consider to some degree a bit of a repricing in the way that margin rates are being applied to both LPs and the underlying user, which tends to be a broker-dealer for our case. I think that day clearly highlighted to a lot of businesses the risks that are inherited within the leverage space. I think a lot of people underestimate what we really offer as a solution, and it was a big lesson to many. Simultaneously, it is our duty, it is our responsibility to educate our partners at all times. But it's very easy said than done. You can try to teach someone certain mechanisms, but it's not until they occur that they actually start listening. From who you choose as your vendor, from how fast is your price, how you distribute liquidity out there, it all means a great deal at times like that. I've been fortunate enough to be in this industry for now over 25 years. And I've gone from experiences with bankruptcies through Swiss franc event, through financial crisis. And it's always been in the back of my mind, how you price customers is key to the market conditions we're in, but you also be mindful that there has to be a clear, conscious risk management approach despite how much business you want to bring in. We all want growth. We all look for ways to monetize the industry, but there has to be a systematic risk management behind every business, because at the end of the day, our decisions ultimately may have an impact within the industry.
Yeah, indeed. Periods of stress actually really reveals who survives and who do not, right? And so we'll hold that question. We'll come back to that later. What about you, Alex Ho? Did you get a lot of client calls?
Yeah, that moment or period is actually very hectic. A lot of clients actually, the whole tempo actually have changed. So people used to look at their gold price maybe once or twice a day, but then they are more stick to their phone or stick to their platform, watching it tick by tick, and adjusting their orders during the Europe Opens and US news, and then the next day the Asia hangover. So we see a lot of people, the trading pattern has become more tactful. They are more towards this pending orders rather than just directly hitting the market. Because of the volatility, and the orders are easily filled. So during that point in time, we see increase in trading volume. And at the same time, it's not only that, clients also trading, when they are trading gold, when we engage with the clients in conversation, we also talk about other products, for example, such as the US dollars, the yield, and then the equities, and even the oil price. All it become a multi-asset conversation.
Yeah, cool. And what about you, Kueh Guan? Where you sit, what were you doing that day?
What was I doing actually? So, funnily enough, we at the World Gold Council are not that concerned about the gold price, as it were. Our activities span the entirety of the gold supply chain, from mining down to the financial products. And this thing, so with gold demand, there's actually different major segments of it. And the way we look at it, we break it down into 4 components. So we have jewelry demand, that's about 25-30% of total demand. Technology demand, which is about 10%. Central banks and official sector demand, about 25%-ish. And the rest of it is investment demand. So what we saw in those times is that as the price was climbing, it was actually depressing gold demand in the technology and in the jewelry segments. Whereas a lot of it was flowing into investment demand and also central bank demand as well. So up to that point, we had difficulty telling whether people were buying because they were hedging, using gold as it was intended in the past as a diversifier and inflation hedge, or whether there was some amount of leveraging and speculation on that market. So once that point where the prices crashed, the volatility told us that demand trends and what people are taking gold into their portfolios for has changed a lot, and how we think about gold demand at the World Gold Council has to evolve with it. A lot of the activity we saw at that time was in the ETF space, but actually in the bar and coin space, demand remained relatively high even in Q1 of this year. Yeah. In fact, I believe grew.
Cool, very cool. So if we put all these perspectives together, maybe Alex, maybe we can elaborate a little bit more about whether this is actually a trend, or is this something that is here to stay, right? Because there's a lot of speculation to say that it's just another gold rally. But from where you sit with high net worth individuals and institutional investors, do you think this is something here to stay?
I think we've got to divorce the kind of shorter term tactical components that have been influenced by the circumstances around margin, the participation in the derivatives market in certain locations, and how that's influenced short-term market pricing, versus the longer-term strategic allocation and reallocation of capital. I think in the course of the last 5 years, you've seen an appreciation of, among Western nations particularly, some of the fiscal constraints, the temptation to inflate in order to remove that debt burden is there. And I think there's a broader recognition, and you see that across the space, whether it's jewelry, whether it's central bank, whether it's ETF demand, or whether it's physical bullion demand through high net worth and like we do. You've seen a recognition that despite rising interest rates, you've seen gold rally into that environment, which is, I guess, a slightly more unusual environment. And I think it's a recognition of all of those factors that we mentioned, and then you layer on top of that within the course of the last 10 years, but particularly accelerated from 2022 onwards, with, again, the multi-asset discussion around, US dollars, reserve currency status, et cetera. How does that apply? Well, you're certainly starting to see global central banks taking a position that, US dollars, or you're seeing gold reflect, and the gold price reflect an increasing probability that US dollars and US treasuries are not the only principal world reserve asset. And, with the total gold market and total value of gold not too far off the total value of the US Treasury market, we're in that environment. And that starts to ask a bunch of other questions around, and this is beneficial for markets like Singapore and where we are, and other non-US centers of bullion trading activity, London, et cetera, and others, is the opportunity to do both ETF type holdings of and securitized components of exposure to precious metals versus physical, and doing that outside of the United States and outside of London, and dispersing that more widely. What we have seen, and we've seen this at an institutional level, is we have seen for the first time in 15 years since my brother and the other co-founder of GPM started Global Precious Metals, is we've started to see institutions asking questions around what happens if, for example, an ETF, which is owned by investors that they are looking after, this institution is looking after, what happens if the physical redemption of that gold is somehow suspended, or exchanged for physical, that the cost of doing that becomes too expensive and you lose something. And that physical gold is delivered in a jurisdiction which may perhaps no longer be quite as friendly as it has historically been. And so those question marks, the mere act of questioning it results in a change in pricing and a change in behavior. And that's what I think we're seeing on this side. But I'm really interested to hear the views of the other guys.
Yeah, interesting. So you mentioned central banks buying gold.
Well, right. Central banks and other similar institutions from a reserve asset perspective. So insurance companies as well, for example.
Yeah, so maybe we'll direct that question to Kwee Guan. So central banks have been known to have been buying gold for an extended period of time. So what is driving that behavior? And what does it say about the institutional confidence in gold as an asset class?
Okay, so maybe a little bit of background on why central banks hold gold in the first place. So central banks hold it as part of their foreign reserves portfolio, but it's typically held as, I guess, an asset of last resort that they deploy. Typically speaking, it would be part of a basket of other currencies as well. So gold is seen as basically the safest thing that they're allowed to hold as mandated through the IMF. And so central banks, gold typically used to hedge against inflation, hedge against volatility. And the World Gold Council, as part of our central banks work, we do survey central banks around the world annually on why they want to buy gold or what's driving their intentions to buy gold, if any. And what we've been seeing in the last 2 years that we've run the survey is that the intention to buy gold has increased. And the reasons for that have shifted where there is intention. In the past, it used to be as part of their typical allocation. They've inherited it from historical assets. They just left it there, didn't do anything about it. Past couple of years, we've seen more and more responses saying that they're hedging against geopolitical risk of some form or another. So most recently, if you've heard, the Central Bank of Turkey has been selling large amounts of gold in response to the war in Iran. So that is a classic case of why a central bank holds gold, so that in times of an emergency like this, they can deploy it to gain liquidity. So another country that's been selling recently that we've been aware of is Russia. In the past, they used to sell annually a little bit as part of their gold coin minting or commemorative coins program. But this year, they've sold a very large volume. We suspect that is also to fund liquidity for whatever purposes they might have at the moment. We don't really get to engage with them because they're a sanctioned country at the moment, so we no longer survey Russia. So in general, we've been seeing as well much smaller central banks and central banks that have not been in the golden, been buying gold for a really long time, last at least 15 years, coming back into the gold market. So places like Indonesia and Malaysia, in the past couple of months, their central banks have made gold purchases, whereas they've been absent from that for at least the last decade or so. So there's a lot more interest from central banks. I guess the price decrease, price drop in the earlier parts of the year might have helped as well to, I guess, buy the dip for these emerging economies, central banks. But most of the activity that we are seeing is in developing economies, emerging economies. Developed economies, not so much. They already have fairly large allocations to gold, and I think they're pretty comfortable where they are. Exception is probably France, but that's really just them selling what they had in New York and buying it back in Europe. So it's kind of repatriation with less steps, as it were. So in general, central bank appetite for gold seems to be high and will continue to be high based on our survey.
It's an interesting comment when you talk about Turkey, because there was a lot of retail narrative around how gold, as a result of the price correction occurring in March, failed to perform that safe haven status. My view, and I'm interested to hear your collective opinions on this, is whether or not you agree with that. My view is that actually I think it performed an exceptional job of absorbing an enormous amount of liquidity that was used to defend the currency against collapse and potential hyperinflation in Turkey. And it did it in a manner that was not politically threatening in any way to a US-Turkey relationship. And I think that's a very important component of what they achieved. And although publicly it was announced they sold around 52 tons, my understanding is if you include, gold currency swaps, that actually the quantum was considerably larger, over 100 tons. And in that context, a nation the size of Turkey mobilizing that degree of liquidity in that short a time frame to protect its currency means that although there was an impact on price, it really absolutely performed its role as a safe haven reserve asset. And I think that's something that, whether you're a central bank in a medium-sized or small economy, or whether you're a large insurance company catering to assets, that's a very important component to think about. So you asked a question at the beginning of this: is this a permanent shift? Our view is yes. I mean, obviously, I'm selling our own book there, in that we're a bullion brokerage and custody business. So yes, we like the idea of that. But I think good point.
Alex is, I think, closest to the retail traders. So what are you seeing on the ground? Is there a behavioral change, or is it the same thing? It's just that there's higher volumes.
Yeah, for the retail traders, they are more towards this. It's totally different from the past. Previously, people tends to buy and hold, especially the Chinese and India communities. But nowadays, over the past 3 years, entire situation has already changed. They are more towards hedging against their currency, because as we know, when we need to buy gold, we need to use our home currency to change and to US dollar and to purchase. One good example over the weekend, it is that India PM announced to the nation, stop buying gold for 1 year. So I think that applies that rupee may not be enough. Maybe also perhaps due to the geopolitical situation in the Iran, whereby the oil price keep elevating at this level, they need more rupees to buy US dollar to buy oil, which is more essential as compared to the gold consumer market on their culture perspective, right? So I think that everyone is on high alert now. So I think that I will foresee that more of this trading activity will be more ongoing in the central bank level and also the retail level.
Interesting. So maybe just expanding on that, you mentioned recent developments in India. So John, where do you see the the center of action or center of gravity for gold trading? Do you think that it's shifting to Asia, or is it that it's still mainly London that determines what the market does? Yeah.
Look, it's a great question. However, it doesn't have a specific answer. The shift from London, from a price-making perspective, will always remain strong. We see tremendous volumes from a trading perspective out of Asia, because naturally or historically, Asia has been one of the regions in the world where the most gold is traded. Now it's obviously the geopolitical event, the current administration in the US has helped retail traders in particular, right? That's what you probably see a lot of, have a higher interest because it's in the media. It's part of everybody's life. Your view is more on the macro side of thing, which is a totally different world than retail trading. We cater to this industry, and what we are as a liquidity provider is essentially a reflection of an industry. When there's high volume being traded, we benefit from that. We see that inflow coming in. Are we at a point in life, geopolitically speaking, there are different parts of the world in very unfortunate situations? That just brings more and more volatility. We have Donald Trump constantly making announcements that just keep driving the market. You watch any news channel anywhere in the world, and people are talking about the geopolitical situation that we're all experiencing globally. So this keeps driving an interest towards a safe haven environment. One of the unique situations I've seen, and I've been doing this for 25 years, is for the first time ever, we saw very significant volumes being traded on silver, which we never did. Platinum, palladium, these are new names. I mean, I've been familiarized with precious metals since, I started my career, but the landscape in precious metals is also diversifying. There's a lot of businesses out there, whether you're an asset manager, fund manager, etc. You're probably looking into these precious metals. No one did before, or at least on a small scale. Nowadays, we see an interest and we see a lot of trading activity coming in. which is exciting. You know, there's to some degree there's a bit of a diversification away from gold only.
So
Again, having credit lines with our PBs is where things get complicated, you know, in the leverage space, but that's a separate subject on its own.
cool, very cool. So I think it's very evident the demand for gold, be it retail trading or like larger central bank demand. So let's talk about the trading infrastructure, right? So Alex Ho, maybe, as you know, gold somehow has the reputation of trading on rather outdated infrastructure, and by that I mean manual pricing, over reliance on a few key benchmark for pricing, and then potentially also limited multi-currency capability. Sorry. So Asia. In Asia, we need our kilograms and grams. We need the cross against our local currency.
It is.
So do you think it's still there's some truth in that?
Not in Singapore particularly, but I think that in Singapore, if let's say you the situation also changed. The landscape, it is that now people able to access to their phone, able to access to the price in their computer. Everything is instant. There is no way calling up a broker. Hello, Alex, can you help me to check the gold price? What is the price now? Confirm and quote them. No way. There is no way to do that. It is because that price move instantly, right? After the news, once the news come out, pop, it's a different pricing already. There is no way that for us to react or find our codes to quote them. So in this case, right, customers always aiming for this high execution system. Or as a broker ourselves, our main concern is whether that are we able to maintain our platform under high intensity kind of volume situation or timing. So we need to ensure that is our primary responsibility, and also ensure that our pricing is definitely in place, not jumping around or whatsoever. Even if let's say they're jumping around, we will actually try to find our most liquid LP or whatsoever to actually at the back of it to make up the spread as low as possible for a good trading environment for clients. So as back to this multi-currency, it is also a challenge. It is always in the conversation whether that customer will ask, hey, whether are we able to trade gold in Sing dollar versus XAU or Sing dollar versus gold or whatsoever. Unfortunately, I think that industry practice, it is not highly in practice. So that is why I do actually tell the client about this situation, and client sometimes also is innovative enough. They do design a program. Let's say, for example, when I buy the price of gold to go up, at the same time they will do they will buy US dollar to go up. So whatever that we studied in our textbook, US dollar go up, gold price go down. In fact, the real situation in Asia particularly, it may be different. Especially when I look at the dollar, Chinese yuan and the gold price, they moved indirectly. So that means to say that Chinese yuan versus the US dollar versus the Chinese yuan, when gold price go up, US dollar will also go up together. Yeah.
So it's very complex, isn't it? With the different dynamics of the markets.
Very dynamic.
Yeah. So you mentioned volatility. So this is a problem when there is volatility, and clearly everyone needs to modernize the technology stack. But then, John, what do you see happen when volatility spiked? What actually happened on the liquidity side? And maybe this comes back to the earlier discussion point. What do you think differentiates the people who did well over that period of volatility versus those that struggled?
Here is the chicken and the eggs. Here we have a real retail brokers, they have to cater to an audience with very aggressive conditions. Then a black swan event comes up, and all that so-called business model suddenly doesn't work very well. So the tech side dictates what you're really capable of. Do you have a fast price out there? What is your front end like? Does it update? Does it have limitations? As we know, there's some trading platforms that have this complexity. customers are never going to be fully satisfied with what you're providing unless you have something really state of the art. And for that means you need to modernize. A lot of the retail brokers, for example, today offer you multiple trading platforms, usually something proprietary, and then you have the genetic stuff that is out there. I think what we learn, not as a business, because I've always taken a very conservative approach, just to ensure that we're still going to be here for another 20 years. But it's very difficult for some businesses to understand that balance between aggressiveness and trying to capture market share versus risk-taking. And at times, they don't mean it, but they're overexposed. And that's what, at a time like that, unless you have the balance sheet to support some of these price fluctuations, some of the partners we've had are not well capitalized. They're just not aware why it needs to be. The fact that you're giving leverage doesn't mean that liquidity doesn't thin out. Refresh rates, when you deal with LP, you need to be very careful. What is that tech staff, what does it look like? How insty is that business really? Do they have the expertise? What kind of execution are you getting? Is there a liquidity management team behind the scenes? In this space, it's all about tag management. How quickly you can convey information to your partner. How you do that, it dictates a lot of times the success of the operation. So it's, again, just what I was saying earlier, is part of the education process we all must go through with our partners. That's what it comes down to.
Cool, thank you. So shall we bring the conversation back to Asia? We've seen Singapore, Hong Kong, India, China. They've made significant move across Asia. Singapore have just launched and embarking on Project Lion 2, and that is building its infrastructure to attract, the physical gold trading activity as well as business into the region. So, Kueh Guan, which of these developments across Asia do you think matters most for how gold is actually traded across Asia over the next few years?
Right. So, full disclosure, World Gold Council is actually part of the working group at the Project Lion 2, but we are completely neutral as to which initiative across the region is most important. For us, I think they are all equally important because they solve a very fundamental problem in the gold market, which is what you elaborated on earlier. The pricing issues, the archaic infrastructure, basically a very fragmented ecosystem, a very non-standardized ecosystem. So to the extent that all these initiatives are an attempt to address all those issues, I think they are all important. As well, all these economies that are engaging in these initiatives, they are all major participants in the gold ecosystem. Singapore, Hong Kong partnering with Shanghai, so China is number one in terms of demand and in production as well. So they all serve a different node in the global ecosystem. I believe Singapore is trying to serve as, a trading port, as usual, a hub of hubs kind of approach between East and West, where the different standards can be traded, can be converted, whereas Hong Kong seems to be positioning itself closer to China and acting as, an international gateway for Shanghai. So they serve a very different purposes. India is itself a very mature market. So I'm sure you all saw the news yesterday about the clamping down on gold imports. The latest news is it's a 15% import tariff on gold. How that shakes out in terms of gold demand, we're not sure yet because India has a very deep historical, cultural affinity for gold. Gold there is not just about store of value or an investment product. It goes into their wedding practices, cultural practices, and it's decorative. So a lot of demand there is in jewelry, is in old school bar and coin, and now increasingly in ETFs. So how that will change with the import tariffs, we're still uncertain. So in general, I think it's only good news, no matter which one works out best, honestly. It solves a lot of problems in general.
Cool, thank you. And Alex, So as we know, there's a lot of interest around tokenization and digital gold. But I understand that maybe the high net worth investors are not rushing to it. What do you think needs to happen to increase the adoption?
So I'd say I've got perhaps interesting perspective on this from two angles. One is from a retail perspective, looking at fractionalized ownership of gold, and then the other and that's through our business Hugo Save, which retail investors can buy fractionalized ownership in small quantums of physical gold that is custodied in Singapore. The pricing mechanism for that is instantaneous, but physical delivery cannot be obtained, but it is physical and it is stored here. On the high net worth side, and the interest in digital or sort of gold-backed stable coin, we looked at that as a group some years ago, decided not to go down that pathway with Global Precious Metals, and with Woodside we didn't allocate in that respect. We were interested directly in owning physical, custodied in a jurisdiction that we trusted, which had decent rule of law, decent fiscal position, and that's here, right? So, we custody here, Woodside's gold assets, and our clients' assets are custodied in physical in Singapore as well. And it's jurisdictions like Switzerland and here that one chooses in that respect. I do think there is a place for tokenized stablecoin gold, and you can already see a very established market participant in this respect, and that is Tether Gold. They're probably one of the largest, if not the largest, gold buyer globally, and that is obviously a tokenized product. I think there is scope for that, and I think looking forward, without a crystal ball, knowing where the world will go in terms of reserve assets, in terms of payment systems, in terms of decoupling potentially between different regions, there is a space for a tokenized gold stablecoin. That there definitely is. The degree to which that can be used for more tradable activity, I think there's a big question mark around that, and Kwei Guan is probably in a much better position to be able to express an opinion on whether that is likely, because that may fundamentally undermine some of how trade is settled internationally, which is well above my pay grade and power grade, etc., to comment on. But those are among the things that I think are relevant to the adoption of a tokenized gold stablecoin on a very broad level. But it's certainly, there is demand for that, not just from high net worths. I mean, I think retail investors want that as well.
Right, thank you. I think we are running out of time, so perhaps let's round up. So maybe let's think about, if the audience today were to walk out of this room, what is the one thing you feel they should take away with them to change their business or trading around gold?
I start first? Okay, from retail's perspective, I think that our job here is actually to differentiate all different clients, treat all clients differently, because different clients, I categorize my client got three types. One is actually the momentum trader. The other one should be the gold hedger against their portfolio. And then the third one is hedge against the weakness of their own currency in order to protect their wealth. So if let's say you having the same conversation, like for example, talk to the momentum trader or whatsoever perspective, you will get the needs wrong. At the same time, it is that because of the evolution of our trading system, we are talking about multi-assets. Multi-assets is also referring that we actually provide a sophisticated platform full of options for the customer. And then if let's say we never give them the proper guidance and guide them the navigation to that correct place, how good the platform is also useless. Yeah.
I'll leave one comment really, which is gold is money. Everything else is credit. And as a result of that, it has a place in every portfolio
I think volatility is here to stay for years ahead, perhaps. Geopolitical events keep driving that particular plays. Just got to be very conscious of what you're actually trading. If you're a long-term investor, that's a certain approach. If you're in CFD trading, like most of our guys are, I mean, our business caters to CFD brokers, then obviously, then it becomes a play of how is your relationship with your LP? Are you able to create a bespoke solution? How flexible is your partner? This is where we come in and we close that gap quite successfully. So it's very crucial you know who you're doing business with and the tech behind as well as the expertise.
And quick one.
Right. So from the World Gold Council's perspective, gold itself has proven to be a very effective portfolio diversifier in the past couple of years. But we do acknowledge that volatility is high, and so we would advise that investors understand what are some of the fundamentals behind gold demand, and to be aware of what's driving volatility in recent months or going forward.
Cool, thank you. So I guess it's clear, gold is no longer a safe haven asset that's sitting in a vault. It is dynamic, it is fast moving, and I think actually the center of the shift is now in Asia. So that presents a lot of opportunity for all of us in this room. The infrastructure, the policy framework, and modernizing the technology stack, all these things are coming together. But thank you very much, panelists, for the fantastic conversation and insights. Please give a hand to all our panelists.